Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. Learn about fix and flip loans, BRRRR financing, rental, fix to rent, commercial, multifamily bridge loans, business loans, and so much more. And now, your host, Beau Eckstein.
Hello. Good morning, America. Hey, this is Vinny Chopra right here and Beau Eckstein, my co-partner right here. I'm from the Bay Area, as many of you might know, right there in Danville, Black Hawk, and also my friend Beau, who used to be in the Bay Area. He's moved out to the Las Vegas area, just enjoying the life over there and enjoying not being in the smoke. Well, Beau, we have been really smoked out, man. I mean, the air is so unhealthy and so for things like that. Again, thank you for joining, everybody. As you will come on, please let us know. I think we have only, a few people are joining right now. And again, this is Vinny and Beau show. We come to you live every Friday at 9:30 a.m. Pacific. We are in the Pacific zone, and 12:30 Eastern, and of course Central will be just at 11 o'clock right there. Again, Beau, how are you, brother?
I'm doing well. Another this week went fast as usual because we had the short week, but every week it just seems to go faster and faster.
For sure. You know, that's the name of the game. When you are really having a lot of fun in your business and everything like that, definitely it's going to try to see here what happened to my microphone. I'm sorry, guys. I was in another meeting before this one, and there we go. You should be able to hear me now. Is that right? Can you guys hear me?
You sound good. Yeah, you sound good.
Okay,
yep.
okay. Thank you.
Guys, just
wonderful.
Real quick, do me a favor and go to meetup.com and /Thrive REIA if you're not opted in there, because every time we do a show, I post information there. So it just will be an extra reminder. Plus we do other mastermind calls and all different stuff. So we want to keep you guys abreast. You can also make sure if you're in my group or Vinny's group that you join both the groups, because there's always things going on. We're always providing value to everybody and want to, give you options out there, and you can learn about what Vinny's doing in the assisted living facility space. They're very, very active right now, and they're going to build 6 new projects next year. They've got a lot going right now, so it's very exciting. So just go there for me, Thrive REIA, and you'll always get updated on the Vinny and Beau show. And then I'm going to put in a little while. I'm going to put some of Vinny's groups and contacts information. Be sure to opt in and go into these groups, and you're going to get a lot of valuable information. Vinny does a show on Thursday night, which is all about assisted living. And so that's a great show to be on, because of Vinny, I really dove deep into learning how to finance assisted living facilities, right? So whatever you're doing, whether you're a doctor and you're saying, hey, I'd love to invest in real estate, but I don't have time. Well, maybe investing passively in a syndication in assisted living, because that's your area of expertise is medical, and you believe that with all these baby boomers retiring, 10,000 a day, that there's a huge demand and need for these type of properties, which there is. And I've been actually spending a lot of time, Vinny, on a lot of calls on like the developers of assisted living. I've gotten a great education about what's going on. It just, not only with your projects, but, on a global scale.
Sure.
And so it's fascinating to see all this going on.
For sure, Beau. And actually oh my gosh, can you hear me okay?
You sound great. Yeah.
Okay. I was going to say that, guys, you're going to be really, really excited because we got a fantastic guest lined up for you to really learn about a special thing that everybody needs. When we buy real estate, what do we need? We bring equity, that we bring in the investors' money in syndication or our own money. But the other big piece, the 70% of the whole deal or 80% of the whole deal, is the loan from the bank, from the institutions, from Fannie, Freddie, CMBS, all those kind of things. And I would like to kind of ask some questions of this special guest. I love him. And he's my co-host right here. Oh, on this side. There we go. There it is. These fingers are not going in the right direction. We are in the opposite, But anyway, Beau Eckstein, I just value Beau's friendship so much because he's one of the top loan brokers in the country. And the exciting part is, I want to definitely say that, Beau, last year or a year before, I needed $8.5 million loan for my multifamily guys. And you know what? Beau started the application and finished the loan, gave me $8.5 million in 15 days. 15 days, record time. And I don't know if he can do it always that, but he's very efficient, very organized, and he's got all kinds of loans. So I will be asking him a lot of questions today. Is that okay, Beau?
Yes. Please do.
Wonderful. So the very first question, Beau, is what should I present to my lender so that they can guide me towards the best financing, based on the property? What would you say?
Sure. So let's just talk about multifamily. Well, first, before I start, guys, here's Vinny, Senior Living Investing Made Easy. So this is where you want to go. Every Thursday, they're doing a live stream. It's really good. You guys should really get to know this space. I think it complements your multifamily business. So anyways, a great place to be. I'll share this again in a little bit, but take note of it and go join that group. All right. So what should I present to my lender? So we're going to talk about multifamily on this one. So
sure.
Really the questions the lender is going to want to know up front is, okay, what's the address, right? Is it a major MSA, or is it a tertiary market, with only a population of 10,000? That makes a huge difference on what lenders have appetites for those geographic locations, right? So we want to know address and location. And if it's in a smaller city, typically we Google it, we look at the population, we look where is it by, right? General questions, we got to know that, because that's going to determine what lenders would probably be the best suited for this particular deal. Obviously, we're going to want to know the unit count, the year the property was built, the current occupancy level. What is the play? What's the play? Are you going to put a major CapEx? Is there a huge CapEx budget, or is it running pretty good and it's just going to be a long-term hold for you? Or are you going to plan on flipping it in 2 to 3 or 4 years, right? So we need to know that, because you don't want to get locked into a huge prepay and have to pay $1 million prepayment penalty. That happens, right? And sometimes you just pay it because you're going to make $5 million. But you got to know that. You got to know. We also want to know what's the experience of the sponsors. So if there's 2 or 3 sponsors in there, what's your experience on multifamily? How many properties have you done? What are you currently holding? And then obviously net worth. So agency debt has a net worth requirement that you have to have a net worth equal to or greater than the loan balance, right? So we got to know that. And when there's workarounds on everything, but you gotta, those are the basic details, right? So then from there, we can kind of assess what makes most sense. Does it make sense to go into a bridge loan? Does it make sense to go into an agency loan? Does it make sense to go into a HUD loan? Does it make sense to go into a bank loan with PACE financing? There's all these different elements we can put together. Obviously, loans under $1 million for multifamily are very difficult, and usually those are best suited for a bank. So there's all these different caveats, and that's kind of the main thing I stress that we need up front. We don't really need to dive through the financials in the first conversation. We just need to look at that first, and then we get a sense of the property. And from there, then we dive in, and then we ask you for 2 years of profit and loss statements, the previous 2 years, and then a year-to-date interim financial statement on top of a rent roll. Okay, and that's as simple. Yeah. From there, we have all the information we need. We do some assessing, and then we take it to the market and we see what options would be best suited for this property, because certain lenders and different programs have different underwriting guidelines. For example, I'm doing a loan with a credit union right now, and although it's fixed for 5 years at 4.25%, they underwrite at 5.25%, right? So you got to be careful, because if they're underwriting at 5.25%, we got to make sure that debt service coverage ratio is over 1.2. So this is all the things, once we get this information, we have to assess, and then we figure out what is the best option there.
So let me kind of ask you, what types of loans are available for construction, self-storage, assisted living, hotels? Are there different lenders who prefer? Yeah.
Sure. So right now with COVID, banks are being a lot more cautious on construction. So for example, most banks aren't lending on ground up construction loans for hotels right now, right? Okay. So most banks are not doing construction, period, which is making it challenging for assisted living and different things. They're loosening up slowly, but right now it's a lot different. Like pre-COVID, it would have been 10 times easier to finance a lot of these type of assets, right? But right now, the hotel industry, obviously, their average daily rate is suffering, so it's making it harder. So what's really kind of the big pushes right now? SBA financing. So anything owner user. For example, Vinny, if you are an owner user of a assisted living facility, we can actually do a construction loan to build your facility with SBA financing. And there's SBA 7A and there's SBA 504, and they're different in different structures. So depending on the deal itself, we gear one way or the other. So SBA is a big player. Now, a lot of banks lend SBA, but very few do construction. So really what happens is when we talk, or I talk to a potential borrower, I have to quickly assess, where am I going to find SBA if this might be an SBA deal? What bank's going to do this assisted living construction loan? What bank will go to 11%? 11%. What bank will do a $12 million loan? Because SBA 7A is $5 million max, right? So you got to pair it with a conventional piece. So there's all these things that go on. That's kind of what I like to do with my job is that I get to figure out how to fund your deals, right? And every deal is different. Yesterday, I got a call from a guy, and he's buying this warehouse or this old abandoned building, and he's going to repurpose it into multifamily, right? But there's very challenging. He's going to buy it for $1.3 million, and needs $3.7 million for construction. So now, I'm asking, I have to ask these questions, and then once I get the foundation of questions, then I have to figure out where to get this thing funded. Is it going to be a private capital deal? And so there's just so many moving parts, and it's very challenging. A lot of people don't realize how challenging our business is because, if you've applied for a lot of loans as an investor, some are easy, some just you don't have to think about. But anything construction, you're going to add a layer of complexity to it, right? So any construction is always going to take 2 or 3 times the amount of regular acquisition on a multifamily. Multifamily is probably one of the easiest asset classes to lend on versus the construction of multifamily, pure acquisition is easy.
Yeah, which is already built and it's performing. There is a history, like you said, 2 years of the P&L, the rental, all those things, and then the experience of the operator who is going to be on the loan, the principals, all those things are very, very important. Also, I know you mentioned about PACE, I think. Did you say PACE? Yeah. What is CPACE?
So CPACE is commercial property assessed clean energy. So essentially, there's been legislation in, I think you're close to 30 states now that have approved it. And each county in the different states have different rules. But California is pretty liberal. Florida is pretty open. Different states have different guidance. So you're seeing a lot of CPACE, and why people are using CPACE. There's a lot of different reasons. One, it's for energy efficiencies, right? So, but developers love CPACE because you can get higher leverage, right? So basically you have a senior lender, you have a senior bank, and then you have a PACE. It's not even a loan, really. It's kind of an assessment. It's like a loan, but it's an assessment. It actually is an assessment on your property tax bill. But the reason it's exploding on the scene is because traditionally the bank might lend you 65% of cost, right? And what does Vinny always do when he calls me? Hey, can we get 75%? Or every developer out there, right? 80%, right? Every developer wants higher leverage because that means they bring in less equity dollars, which means they get higher returns for their investors, right? Um, yeah, and this is a good question. Somebody I can't see who it is. CPACE is approved in a lot of places, but we found that most lenders do not accept it as part of the capital stack. Yeah, so that's very true. CPACE is so the big part with CPACE right now, and I have a list of all banks that have worked with CPACE. So, for example, I think there's only been one HUD multifamily construction deal that got work with PACE, and that might not. So HUD is very difficult to work with PACE, right? So your best bet is there's a lot of regional banks. I have the whole list of, there's a lot of deals getting done. There's been $1 billion in 2019 funded through CPACE. So, and by 2025, it's going to be $10-20 billion and so forth. It's going to grow into a mass amount. So whoever made that comment, you're exactly right. CPACE is you have to get the senior lender on board. So we work backwards. So as I've kind of dove a little bit deeper, I'm still have a lot to learn, but the key is to get the deal. So when I'm assessing a deal, Vinny, it's like, okay, it's going to take a while to get on board, but we can look at a construction budget, right? So we get a construction budget from Vinny. Vinny goes, okay, it's going to cost me $13 million to build this project. Mm-hmm. So then we can basically take that budget, that line item budget, and make a proposal, because we can take the items that are PACE eligible. We can basically figure out from there what would be the loan proceeds from PACE, essentially. So maybe on that $13 million deal, you're going to get 20% of those funds that would be able to use in the PACE scenarios, right? So then we know in the capital stack, right? We know that we got 13 million in construction, okay, and then we got about, let's just say there's 20% of those costs, 2.6 million, I believe, right? That are eligible for PACE, right? So what PACE does then, so now instead of going to the bank and saying, hey, we need 65% of $13 million or 70% of $13 million, we now have PACE on board, and then we work our way backwards and we find a bank that does that type of transaction, that's done work with PACE before. We get them on the phone with the managing director of these PACE companies that have basically written the book on this. They're the guys that have done like the first PACE ground up hotel deal, right? So you get principals like that on the phone with the senior director at the bank. You make things happen in that sense, because at the end of the day, really it's lower leverage for the bank. Instead of the bank having to lend 75%, maybe they're only lending 65, and now the PACE piece is 20% of the capital stack. So you as the developer get 80% or 75% loan to cost. You're happy because you're getting higher leverage. Yeah. The bank's happy because they're doing good. The idea of PACE is to have a good impact on the environment too, right? So when you're going through the due diligence process, you're going to get a huge engineering report that shows you like what it's going to save you from an energy standpoint.
You're listening to the Investor Financing Podcast. We'll be right back after this break. Are you looking for funding? Are you getting frustrated trying to find a lender? Visit investorfinancingpodcast.com and click the Get Funding button. Complete the simple form and schedule a free phone consultation with one of our placement specialists. We have a proprietary directory of funding partners that can help you get the funding you need. It's fast and easy to explore the options available for your specific needs. Don't wait. Visit investorfinancingpodcast.com and get connected.
So it's the way I look at it is we're doing good for society. We're doing good for the developer. I'm happy I make some money on originating a loan. And at the end of the day, we're constructing and rebuilding properties that have been sitting vacant, right? Because a lot of these properties are maybe conversions. We're going to see a lot of conversions. We're going to see a lot of office space converted to multifamily, or hotels converted to multifamily in certain markets. We're going to see a lot of that right now because of what's going on with COVID. So having these tools in your tool belt is essential, right? As an investor, when I put my investor hat on, it's like, okay, I could buy a property with seller finance. I could do a hard money purchase. I could get a hard private money investor, right? We need to have these different tools So we know how to attack each project. And that's what I do for my clients, right? I talk to you, Vinny, or I talk to a client. I say, okay, what are you trying to accomplish? Okay, of course, you're always pushing to the limit. That's fine, right? You want to get the lowest rate, the highest leverage, but that's what we do. That's our job.
That's so true, Bo, what you're talking about. I know always, the developers or the purchasers of the properties and all that, we're always looking for good terms, of course, and also have the assurance that we can close. See, that's also is very, very important. I think I've found that out in my 14 years of career in purchasing apartment buildings, is that you want to work with a broker who's trusting, who's very transparent, who is on top of things, and who is able to take you to the closing. That is the real deal. You cannot just have somebody haphazard and then, at the middle of the thing or after due diligence find out, oh my gosh, we got to start over again to get a lender on board. So that's so very important to find the right broker. No, thank you so much. So, Bo, what does this mean now? You said it's the clean energy. So with the new codes and all the things that we have to take care of anyway, do we have to put some new products or some equipment in the buildings for the clean energy, or how?
No, I mean, there's a lot of stuff like HVAC. In some jurisdictions, they allow for foundation as part of the PACE. So each jurisdiction has different things. And so when we go in, we'll assess on your construction budget based on the location of the property. We can extrapolate and give you, here's what we can get you for proceeds for PACE. So, like if it's a $20 million ground up construction loan for a hotel, for example, and it's in California, we can get you, somewhere between $5 to $6.3 million in proceeds from PACE, right? And that could be in different areas. They amortize it in a different. So in California, you can amortize those over 30 years. Mm-hmm. So the trick will be on construction too. The other good thing about PACE I want to bring up too is that some of your properties that you're building right now, your assisted living, even though you did not use PACE on the construction component, they have a look back period where you can get capitalized for those costs. So we would just go back to your senior lender and say, hey, we're getting recapitalized for these costs of PACE. Try to get them to sign a lender consent, meaning it's okay. And then you can get, let's say on the last one you built was $13 million, maybe there's $2.5-3 million you can get back, right? And so people are doing that. People have gotten stalled on construction projects that didn't have PACE. Now they bring PACE in to finish the project because they're able to, in some cases. I mean, that's not what PACE was for, but there's a lot of uses for it. So, I'm excited to show you, some of the advantages. It's not going to work for every project, but there's going to be a good handful of your projects where you're going to say, okay, it makes sense, and I could raise less money and accomplish the same thing. And anytime you can raise less money, and let's say the PACE is 6%, as opposed to paying 20% or whatever that costs for that equity coming in.
What you're talking about, Class A limited partners, usually, it's 17, 18, 19, 20% ARR, right? Average returns for the year, per year. Of course, the IRR will be a little bit lower. You're right. So this 6% is really very good money. I mean, I'm very fascinated when you shared that with me and our partner, Imran and John. So let me ask you a question. This is an assessment, you said, or something. So we pay in the taxes. Do we pay once a year then, or how do we do it?
Just like you would pay property taxes. Now, some jurisdictions are a little bit different, so they break it down. And then the interesting thing is you're going to have to talk to a tax preparer, but you can take it as an operating expense, right? So you might be able to take it as a different expense, which might be beneficial. We need to get somebody on that understands that. Yeah.
Surely. I mean, as the property taxes, assessment tax, insurance, that come in the P&L, profit and loss statement, above the line before NOI. But of course, if you're paying it in the interest on the mortgage, or if it's coming, that's below the line from NOI, net operating income. So I really see this expense, Yeah, okay.
And the other thing too, which I think is going to be huge, is that let's say you've owned a building for a while and you have you refinanced during a great time. You're at 3% fixed for the next 10 years. You don't want to refinance your first lien, right? Well, you have deferred maintenance and you want to upgrade, you want to put a new roof on, you want to put new windows on, potentially we can actually use PACE to use that as long as we get consent from the lender, the senior lender. So maybe you're able to get $1 million or $2 million to do the retrofit of the building, right? Without having to touch your senior debt. So there's lots of options out there. And I think you're going to see more and more and more of that. And especially now more than ever that there's a lot of buildings in urban areas that need to be redone and repurposed. I mean, and the cities are encouraging it, right? Because what do cities want? Cities want sustainable growth, right? And they want to bring people to their cities because that's how they generate income. So as developers, you're doing a good deed for society, right? First of all, if you're doing assisted living, you're helping the population, live the life they want to live, right? By providing very clean and new luxury stay, right? Which is the key.
The nail on the head, buddy. I was going to ask you if you can show the movie to our viewers. I know you're financing our constructions. We just finished the one in Cape Coral, and you're getting us the loan in Punta Gorda and Williamsburg, all over, So are you able to show it, or can I show my screen, or how is that?
Yeah. So, share your screen, Biddy. So go.
I'll share the screen right there, and it has to be, I think, the Chrome tab. There we go. Yeah. And here is the movie right over here. So if we could show to our friends who are watching us, and again, thanks to you, Beau, that we'll be able to build some properties just like this one.
Welcome to Hampton Manor of Cape Coral, the Cape's newest premier independent assisted living and memory care facility. I'm Amy Hannah Eckenrode, Community Development Manager, and I would like to invite you to join me on a tour of our beautiful community. Hampton Manor of Cape Coral features the only 77,000 square foot, one-story facility in the area. As you enter the facility, you are greeted by 2 comfortable sitting areas, and behind our grand waterfall is the formal dining area for independent and assisted living residents. All award-winning meals are created just for you by Chef Larry DeLuzio and are served restaurant style. With 3 gorgeous garden courtyards, residents can enjoy our in-ground swimming pool, putt-putt golf, or the beautiful rock formation waterfall.
I love how they're single story, Vinny.
Yeah.
Our stylish beauty salon will have you looking glamorous in no time.
Look at that. The spas. Salons and spas.
Our activities calendar keeps you on schedule and in the know. Our luxurious spa allows you a tranquil place to unwind and de-stress. The club room is designed for some hearty pool or card games. And right around the corner is our private library. Enjoy afternoon snacks and entertainment in our poolside bistro. For a relaxing conversation in our sitting room overlooking the waterfall courtyard. The Modern Theater invites you to indulge your senses in a delicious bag of popcorn and your favorite movie. The spacious sunroom invites you and your guest to take in an afternoon of conversation or perhaps a puzzle or card game. Our activities room will be filled with bingo games, trivia, and arts and crafts projects for creative minds. Or enjoy watching a game show or the daily news with your friends in the social lounge. We offer 89 spacious apartments featuring private or courtyard views, kitchenettes, and equally spacious restrooms, and the ability to control your own room temperature. Whether you like a studio apartment, our one-bedroom apartment, our two-bedroom apartment, or our one-bedroom deluxe apartment. There is a size and design to match your lifestyle. Our 16 apartment memory care area features a private dining room. Overlooking the lush putt-putt courtyard. Each spacious studio apartment is warm and welcoming. Our entertainment and common areas are inviting, and our staff will be here to ensure your loved ones receive the very best care. At Hampton Manor of Cape Coral, our residents get the daily support they need while remaining as independent as possible. We extend our highest level of service, value, and quality, everything you are looking for in an assisted living community. Hampton Manor of Cape Coral. Let us be the writers of the next happy chapter of your life. Call us today at 239-823-9579 or visit us online at www.capecoralassistedliving.com.
Thank you. Thank you.
Excellent.
Thank
Yes.
you. Thank you for sharing, letting me share that. Bo, we are so proud of, what we are building as the senior living. One story, by the way, as everybody who just watched us and will be watching this stream, later on. And also to see, we are building only one story with 5 to 7 acres of land. Hold on. 5 to 7 acres for only 90 units. So we want to give the lifestyle to our seniors, our seniors who need the assisted living in the age of about 80, 85 to 100 years of age. We don't want them to climb the elevators and doing all those things to second story, third story, fifth story, not at all, but also have the courts where they are able to go from the unit outside with their caregiver or themselves and put the plants and flowers and vegetables in the garden and really build the camaraderie of their fellow residents. As you see, so many places, dining is all restaurants, the movie theater, the spas, the library, the salons and the sunrooms. I mean, we are trying to put all the luxuries into these livings so that we can really spoil the generation that has spoiled us.
I love it. Love it. Yeah. I know when we were funding, working on your loan, we were looking at other communities in the area, but they're all the proposed communities are all 2, 3, 4-story properties, right? To me, single story is the way to go. I'm even seeing that trend happening in, well, obviously not urban areas where they don't have the land, but you're seeing a lot of developers now switch their multifamily buildings to more of a similar style because people like to rent. People want new. Some people don't want to buy. Some people are downsizing. So in multifamily, I see that as a bigger trend too. As people start working from home more and they're able to live in a suburban market, but close to the city, maybe they can drive 20 minutes and they go into work once or twice a week as opposed to going in 5 days a week. I think you're going to see a lot more of that. Mm-hmm. So I think you're going to see these multifamily suburban developments happening, like, for example, similar to like what you guys are developing in Michigan with those townhouses. You're going to see more of that, maybe a little bit more clustered together, but as opposed to multiple stories now, I think you're going to see people that they don't mind renting. They'll pay the extra premium but they want their space. They want to have a home office. Yeah. And so I think you're going to see a lot of that kind of development coming forward here.
So true, Beau. And like you said, in our starting of the show, that silver tsunami that's going through our country, 10,000 baby boomers turning 65 every night, every midnight, 10,000 of us, I'm a senior citizen, not you. You're a young guy, but the key thing is they need to really find the best places to downsize is one word. And then also they're moving to the warmer climates. That's the other thing as we get retired and so forth like that. So people in the 80s, 85, 100 years, when they get that need to get some assistance, they will be the ones who will be able to come to our communities. And with the luxury that we are bringing, it's not the residential assisted living at all. That's a whole different ball game with 6 or 8 rooms and things like that. This is the multifamily senior assisted living multifamily, we call it, a community where the residents can get a full respect and dignity in living.
I love it. Yeah, no, it's great. It's great. It's very exciting.
Thank you. I do want to ask you some more questions now, the capital stack and how it works to get higher leverage. Can you kind of talk about that a little bit?
Sure. So depending on the type of project it is, it could be construction, it could be an acquisition and rehab of a property. But when we talk about capital stack, we're really saying there's different pieces of the equation. So you're a syndicator, right? So you're getting debt from a bank or agency, right? And that's a big part of the pie. But also there's a 25% or 30% void of equity that needs to come in, right? And let's say that you weren't Vinny Chopra and you weren't able to raise $16 million by easily, right? Because some people don't have the same money raising skills as you. There's also different pieces of that capital stack. So for example, I might get bank financing at 65% of the cost of the project, right? But we need 35% more, right? So maybe I get what they call a preferred equity piece, and there's large institutions, there's private equity funds that lend this piece, and that might be at, the bank piece might be at 5%, the preferred equity piece might be at 12%, and then instead of them having to raise 35, now they only have to raise 15, right? So that's a pref equity piece. So the interesting thing going back to why PACE is instead of paying 12%, I'm going to just show you a point. You can, instead of pref equity, what if you can bring in CPACE?
Yeah,
instead of that, right?
Like you said,
you're 6%, plus it's amortized, plus you don't have to pay it back for 30. You can pay it back, in the quarterly property tax bills. So then you're not rushing to have to refinance necessarily too. So there's huge advantages. So PACE kind of takes that piece. So really, when we're talking about the capital stack, it's about putting all the monies together. And maybe, Vinny, maybe you might buy a portfolio of 13. There might be a company that's retiring or a very strong family office that wants to sell their portfolio. And let's say it's $100 million or $200 million sale, but you're buying like 13 A quality apartments or whatever that is, right? It might be hard to raise that $70 million. So maybe at that point, it might make sense to get a pref equity piece to facilitate. So instead of raising 70 million, you only have to raise 30, right? So that's why you see a lot of that in the big developments, is that there's different banks that come into play, because not all banks want to lend $100 million on one project, right? So these different banks participate in these deals. And then there's tax credits. If it's affordable housing, there's programs for affordable housing. So you can actually layer all these tax credits and stuff within so depending on what the project is, where it is there affordability housing component of it, you're able to kind of layer different pieces to this whole equation. And that's basically what the capital stack is.
Awesome. Man, Beau, you have really given us so many golden nuggets, in this show. I appreciate that very much. I know one more I wanted to get an update before we wrap up the show is on the HUD financing. What's going on with the housing, urban housing division, is that right? HUD?
Yeah, so basically, because agency with COVID, they scrutinize a little bit harder now, where HUD historically has not been as stringent on the location of the property, right? Like if it's in a secondary or tertiary market, agency might say, we can only do 65% of costs, where HUD pretty much keeps their ground, right? They can do higher leverage. So right now with the pandemic and banks not being aggressive and agency not being as HUD, what was the stat I just read? It's pretty incredible. Basically, HUD has issued more commitments through the third quarter of 2020 fiscal year than any other full year in history, just in that quarter.
Wow.
But HUD was getting quicker. Like if you work with a direct HUD lender, you can streamline like an acquisition of just a normal acquisition. I'm not talking about a heavy rehab. You could close those in 90 to 120 days. But now, because they're so busy, you're probably 120 days plus now, right? Because everybody's trying. Where else can you get 35-year fixed rate loan at 2.54%, right? Or if you're doing construction, so they also do for health assisted living, and eventually we got to do one of these projects with HUD. We can get up to 85, potentially 90% of cost on a 40-year term fixed rate for construction.
Wow.
And you're talking about 85% leverage. So if it fits the criteria, they're very stringent on healthcare, which makes it a little bit challenging. But if you're doing a bigger project and get the right team, the right location, I mean, it's it's probably the go-to for healthcare, because I started going through all the owners of all these assisted living facilities, and so many people have financed with HUD, right? Some people just don't want to deal with HUD, but I mean, it really is really good leverage. So that brings me to the last part I want to talk about financing for today.
Yes.
Is how do you fund a poorly managed multifamily property, right? Agency wants your property occupied at 90% or greater, HUD 85 to 90%, right? What happens if you're buying a multifamily property? Like a lot of people getting started, and a lot of people just like to buy these mom and pop type of properties, right? They're 30 units or 20 units. They're 19 units, maybe they're 50% occupied, right?
Yep.
So the debt service coverage ratio is obviously under 1.2. It's, some of them are breaking even barely with, so obviously you can't get agency or bank debt typically on something that's needs 300,000 of CapEx and it's at 50% occupancy. So that's when we bring in bridge lenders, and there's all different bridge lenders. There's bridge lender. The majority of bridge lenders want to make loans 2 million and greater, but I have a lot of bridge lenders that will do, anywhere from $1 million to $4 million. And so the last one I just did basically was a purchase price of $850. And it had 300,000 in CapEx, and then it was going to be worth 1.6 million stabilized, right? So it was a great deal for a newer investor. The problem was he didn't have 25% of cost, right? So typically these bridge loans want at least 25 to 30% of cost.
Nice.
So of cost is, 30% of purchase price and 30% of the construction budget, right? So he would have needed roughly 850 plus 300,000 construction budget. He would have needed, say 25% of cost. He would have needed 300, 350 cash to close.
Mm-hmm. Yeah.
Plus he would have to make monthly payments, right? To debt service. We were able to structure a deal. It's not the cheapest money in town, but it's just the point that I have a lender partner that will lend up to 75% of the stabilized value. So assuming that you get a great deal with a lot of value add and you could turn this project around in a year, you can get almost 100% leverage.
Wow.
Yeah, because they'll lend 75% ARV. That's only for certain circumstances, but that's the point. Everything's different. When you call me, maybe there's a component. The other thing is like, if it's a hard deal to fund, what you could do is maybe I can structure the first senior debt in some kind of bridge loan. We have a conversation with the seller, say, listen, this is so hard we're going to try to get you a higher sales price for you, right? Because the seller wants more money, but you got to work with us and you got to carry back a second lien on the property, right? So let me buy the property. I've got a bank or a fund that's going to lend, X amount, and they're going to cover the rehab. I need you to subordinate a seller carryback. So they put a secondary lien in the back position or second position.
Right.
Then I'm able to fix the property, stabilize it, and then roll it into an agency refinance, right? And I did that with pretty much none of my own money by having a seller on board with it that says, I like what you're doing. And so that's very common in kind of the mom and pop type multifamily stuff. And especially if you're not very equipped at raising money, right? So there's multiple ways of doing this and piecing it together. And that's why mortgage brokers are around, because you can go to ABC Bank and they're going to give you only what they can do in their small little box. Where I could take that bank, I could still do a deal with them, but I have all these other banks. So depending on what you want, we can get you the best deal. That's why brokers always can get the best deal for the client, because we shop and partner with all these people.
1000% on what you just said. Beau, exactly. In my 14-year career in buying 30 deals or so, you're right. Brokers, loan brokers, mortgage brokers are the best people because they have the relationships built in. They have the whole stack full of banks and agencies and all they can tell your story. They can build your story is the word I say. And they can sell you and your system and everything, what you need, and consult with you like you, Beau, and get you the best deal. So that's really, and some people think, do I want to pay 0.5? 0.75 or whatever, or 1%, it's well worth it. I mean, I want to make a case right now.
Yeah.
That's the best investment anybody could do, really, because you will save money in the best terms, thousands of dollars, and you'll be able to close it on time. You'll be able to have somebody on your team, on your side, who will guide you along, like Beau Eckstein, my good buddy, to the finish line. And that's so important, So, no, it's such a great one, Bud. I'm so glad, Beau, we did talk about it. And, I know we'll get a new guest speaker next week. Guys, please comment, if you will. If you like our show, pass it on, share across your channel, and also let us know how we can help you, support you, Beau, with the loans and all the kind of financing that he discussed today, we talked about, and then also for passively investing with us in senior living, luxury senior living, or living in one of them also facility. We are looking for locations all over USA. We'll be building on. Then multifamily also. Beau, I wanted to mention it, but we are closing in 55 days on our Austin deal. Next Monday, we are able to close, and we raised $17 million in just 2.5 weeks. $17 million. And that was on the heels of my raising $4 million over the one weekend for senior assisted living in Punta Gorda, $4.2 million before that for Williamsburg. I sold out, and I had to return $900,000 back on that one. So it's ridiculous. During COVID, so much money we are able to raise, 17 plus 8, 25 million in just 2.5 months and so forth like that. So God is good. But let's come back, guys. Thank you again. Please do put notifications so that you could join us, so that we can ask you your questions that we can answer. Right, Beau?
That's right. And thanks everybody for listening. Be sure to share it. Be sure to go to Vinny's group if you're interested in senior living investing made easy right here. Make sure you go to the meetup.com page that I've had for years, because we put all of the events, including the Beau and Vinny show. We need you guys to get there so you get all the emails and notifications, because we are always bringing new guests on the show. Yep. And if we're not, we're talking about good topics, and we're going to continue to do this. And thank you, Vinny, for the great questions.
Thanks for listening to the Investor Financing Podcast. For show notes and useful resources, please visit investorfinancingpodcast.com. For questions or comments, email info@investorfinancingpodcast.com.